Hello, everybody, and welcome to the SANAD Does Fintech webinar for October. Today, we're focusing on raising capital at seed stage and beyond. My name is Ian Jenkins, and I'm the FinTech lead for Base 115. We're working with SANAD in partnership to bring this to you. We're going to start with a very quick video that talks about some of the things that SANAD does and highlights one particular story of an organization that SANAD has supported through a loan.
حضرتك انا احمد سعد زيان من البرجايه محافظه المنيا، وجايب معايا والدي سعد زيان هو صاحب المنشأ انا وهو. حضرتك جايين ناخد صفيح من القرض بتاعكم، جايين ناخد صفيح جبنه هنعبي فيه الجبنه اللي احنا بنصنعها.
لو حبيتوا تفضلوا معانا في اي وقت تتفرجوا على المكان وتشوفوا التصنيع وتشوفوا العبوه، تعالوا في اي وقت واحنا نتمنى نتشرف بيكم في اي لحظه.
حضرتك دوت الحوض اللي انا بستلم فيه اللبن وبسخنه وبنفعه، وبعد ساعات معينه بحطه في الجوالب ديت، وليه ساعات معينه بفضي فيها الجبنه ديت، وبرضك في ساعات معينه بحطها هنا واطلعها جبنه تاني يوم الصبح. انا بحب الزبون لما بيجي عندي وبيقول لي عايز اتعامل معاك وياخد جبنه مني ويشتغل بيها وتعجبه، بتبسط منها جدا وانا بتبسط. حضرتك كان والدي عنده بقره ووالدتي، فحضرتك حابين يكبروا المشروع، مش هيفضلوا على حالهم زي ما هم، فجابوا شويه لبن وصنعوهم جبنه وعملوهم، فجابوا الزباين جت خد من عندهم فعجبتهم جدا جدا، فوالدي حب يكبر المشروع، اشتغل كافح وكبر المشروع، فعنده استعداد ان هو يكبر ويبيع 1000 طن في اليوم. وانا من بعده يعني انا كان مسكت معاه شغال، كملت معاه المشروع. هو كان الاول صعب، بس لما عرفت شركه ساندا وموانتني بالمشروع وما تعبتنيش معاهم، غير بره البنوك التعامل مع البنوك متعب جدا، غير شركه ساندا هي اللي موانتني على طول ووقفت معايا وساعدتني ان انا اوصل اللي انا فيه ده. نفس اليوم حضرتك انا اخدت 100,000 جنيه، فيا دوب اللي انا اشتريتهم بيه حاجات تحرك العجله مشيتني 15 يوم، ومن وراها انا اشتغلت، جبت الصفايح، جبت العده بتاعتي، وابتديت اشتغل مع الناس بتوع اللبن.
فانا فخور طبعا بيه جدا اللي هو سندي، لان هو ده مشروعه هو مش مشروع انا بكره وبعد مشروعه هو واولاده مش مشروع انا.
انا عندي 3 بنات عايزهم يكبروا واشوفهم في احسن حال، وان شاء الله باذن الله اللي حابه تشتغل معايا، لان الشغل مش عيب، يوزعوا بره انتاج، تديهم يشتغلوا يوزعوا انتاج. اشكر شركه ساندا وصندوق سند، الحكومه الالمانيه والاتحاد الاوروبي، والف الف شكر لهذه الشركه اللي بتنفذ هذا التموين في مصر، وشكرا.
Fantastic. So just one example there of some of the work that SANAD's done in the Middle East, North Africa and Sub-Saharan Africa regions. We're talking today about raising capital, and I'm not sure there's a more important topic for most startup businesses, or indeed many businesses at any stage. We're talking about a region where in the first half of 2021, over $1 billion was invested in startups alone. And we're seeing that as a 64% increase on the same period in 2020, albeit of course we know that COVID had an impact at that stage. I'm going to pass now to Peter, who's going to tell us a little bit about SANAD. He works with them. And then we're going to come back and talk through some very brief housekeeping.
Yeah, thanks, Ian. Welcome everyone to this webinar series. Pleasure to have you all here. This is the second iteration of the webinar series we have launched as the SANAD Fund. There are 4 more to come, so stay tuned for other interesting topics that we'll cover around the world of fintech, raising capital, etc. So quickly about me, my name is Peter. I'm part of the equity team of the SANAD fund. Before that, I was part of a venture capital fund specialized in fintech here in Germany, and I was part also of a startup accelerator in the Netherlands some time ago already. So why do we do those webinar series, and why the focus on fintech, and how this ties up with the mission of the SANAD fund? So basically, the SANAD fund has one main mission, and this is to support micro, small, medium enterprises in the MENA region and in sub-Saharan Africa. And how we do this is through three main instruments. So this is debt, equity, and technical assistance. With the debt financing, what we do is we support financial institutions by providing them credit that gets on lent to the micro, small, medium enterprises. And in this way, we help those MSMEs cover working capital needs, or cover also fixed assets purchases that they might need to buy. And with this, we support them grow their business, increase their employment. On the equity side, it is a bit more flexible. We invest directly into financial institutions, but also increasingly in fintech companies, agtech companies, insurtechs, basically companies that touch on financial inclusion and support to MSMEs. And here, why the focus on fintech in particular? This is because there is a quite significant financial inclusion element that fintech companies could achieve. And this is quite important for the fund as well, as this is the main mission. And we see that there are multiple facets within the fintech industry that deliver financial inclusion and better access to finance, etc. And the third element of our support that we provide is technical assistance facility. This is quite important, and because this is a needs-based capacity building that we provide to our investees. We sit together with the management of the companies, with the board, and we design areas where they need support, and the technical assistance facility pays the majority of the costs of this support, delivered through external consultants in most of the cases. So this helps quite significantly the investees by, on one hand, alleviating cash, and we'll speak about it today, how important cash is, especially when planning a fundraise. And also it brings external consultants and external expertise to those companies, which is quite important. And yeah, indeed, now with this webinar series, we would like to continue on this support and create more awareness around interesting topics, especially in the realm of fintech, and have also some interesting panelists as well on the table that can share their experience.
Thanks, Peter. That's fantastic. SANAD doing some wonderful things in the region, and a really interesting organization that provides that 3 tiers of support that you've talked us through there. As I said earlier, a little bit of housekeeping from me. The agenda today, the first batch of our moderated panel discussion is going to cover an introduction to the topic, really. We want this web series to be accessible to anybody, no matter their level of understanding of the topic. So we're going to run through some of the very basics initially, and then we're going to talk through some polls, some of the questions, and move on to more complex and perhaps more detailed analysis of how, when, and why people raise capital, or businesses raise capital, I should say. You can tweet, and please do tweet about the series today. We're using the hashtag SANAD Does Fintech. You can also ask questions of our panelists. There'll be a Q&A session after the last 15 minutes. You can find the Q&A function at the bottom of your screen. Please do submit questions. And we look forward to hearing from you throughout, but we will be addressing those questions, as I say, at the end. So if you submit something right now and you don't hear me come to it for a little while, fear not, we will get to you. I'm now going to ask the panelists to introduce themselves. I'm going to start with Jenny Alzain. Jenny, tell us a little bit about yourself, please.
Thank you very much, Ian. Thank you, SANAD, for giving me the opportunity to speak here today. I'm impressed because Ian was able to pronounce my name properly. Yes, it's Jenny Alzain. I'm a partner and co-founder of Amman Ventures. We are an impact fund that invests with a gender lens. And really what that means is to support and invest in companies that are committed to diversity and inclusion. I'm not sure exactly how much you want us to talk about what we do, but I have a background. I used to work in venture capital prior to starting Amman Ventures. I sit on the board of Vitas Jordan, which is a microfinance institution here in Jordan. And yeah, I'm really excited to talk about raising capital here today.
Fantastic. And I know I speak for everyone that's on the call when I say we're all fascinated to hear from you, Jenny. So thank you very much for being a part of the panel. I'm now going to pass to our third and final panelist, by no means least, Chris Thomas. Chris, tell us a little bit about yourself and Eureka.
Thanks, Ian, and hello everyone on that's attending this session. Yeah, my name's Chris. My name's Chris Thomas. First and foremost, I come to you as an entrepreneur and also investor. I've been an entrepreneur most of my life, and pretty much for every business that I've set up or been involved in, I've needed some access to external capital, be it loans from my mum all the way through to angel investment, private equity and venture capital. And so I'd also had some pretty decent exits in my time. And so I've been on the other side of the coin, investing in entrepreneurs, both locally and globally. I mentor various entrepreneurs on fundraising and also I'm the trainer on various incubation schemes here in the region, mainly through that fundraising lens. But the day job is co-founder, co-CEO of a crowdfunding platform, an equity crowdfunding platform called Eureka, where ultimately what we do is that we provide a platform for entrepreneurs, large and small, to raise money from their network and our network. And so our job is to really, if you like, empower and inspire that entrepreneur and hold their hand through that whole fundraising journey to help them raise cash. So have a lot of personal and professional experience and perspectives on fundraising at all levels, and look forward to sharing some of those insights with you throughout this panel.
Fantastic, and we're really looking forward to hearing those insights as well, Chris. Thank you very much for agreeing to be part of the panel. We're now going to move on to a discussion, and I'm going to first go, if I may, to you, Jenny. My question is a fairly straightforward one, and forgive my ignorance, if you like, but what do we mean when we talk about raising capital? And does it mean different things to different organizations? And does it mean different things in different parts of the world?
Sure thing. I think, yeah, I mean, what do we mean by raising capital? I think really it's a process of securing money to either start your company, to grow it, or to take advantage of an expansion opportunity, right? There's a wide spectrum of, I think Chris mentioned it nicely, there's the debt funding, there's the equity funding, and then there's this thing in between, which I work with now, that is a combination of the two, which is mezzanine financing. Where you're at in your journey really depends on what type of funding that you will be seeking and the type of funding that you need and that's suitable for you. But I think it's pretty safe to say that wherever you're at in the process, raising capital and securing external funding, it's a long and challenging process, and it's tough and it's hard. I think equity, it's much more suitable, at the earlier stages when you want to grow your company fast and you need capacity to scale your operations. But it's also about bringing in smart money, right? It's not just someone just coming in and give you money and that's it. But often they would require a board seat, for instance, and they would sometimes have a very strong opinion of how the company should be run. So, equity, you can do it at the early stage, or you can do it at the private equity, or even IPO at that stage as well. Debt is really good if you need support with working capital or CapEx requirements, but a lot of the time that doesn't really fund an expansion plan if it entails a portion of, let's say, growing your team, or a large portion of marketing, let's say, for instance. And at the early stage, I would say debt is often not an option at that stage. So SMEs, which are the ones that I focus on, they fall in between this, right? Because their business model of that most of them is not, they don't necessarily want to be the next Kareem or the next Uber or the Facebook, and they don't really fit that VC type of, grow fast type of model. And they might not have a natural path to exits, or they might just be a family business where they say, I want to keep this with the family for the generations to come. So those are the type of companies that we speak to and that we support. They don't have that VC funding, but also they don't necessarily have the collateral that they need from a bank. So yeah, I spoke a lot, and I hope I answered the question, Ian.
You did. Thank you very much. That was extremely insightful. Chris, I'm just going to pass quickly to you. Jenny's given us a fantastic definition there. Obviously, Eureka is a technology-driven organization. So do you see technology changing that definition over time, or will it remain broadly as Jenny's described it to us just now?
Well, I mean, technology is an enabler, right? I mean, ultimately what we do as a platform, as with most online platforms, we make the process a bit more efficient and scalable and allow you to raise money from people that aren't just in your local network, but are global, right? And that you can reach through online as well as offline mechanisms. And so I don't think we've changed the game. We've just made the process a bit more efficient and accessible to, or democratized, as we often like to use, to a wider group of people. But I mean, as Jenny rightly says, I mean, you know, fundraising, to be clear, you know, when you're raising capital, you're raising a chunk of money to do something with. It's a means to an end. It's not the prize, right? We often as entrepreneurs think we raise cash, right, brilliant, you know, we're done now. That is merely one step on the long and fun, but often painful road of building a business as an entrepreneur. And so, you know, bear that in mind. It's a means to an end. It's a milestone rather than the end itself. But as Jenny says, it does mean different things to different firms at different stages of the business cycle, right? It's, as Jenny says, it's very difficult to get a loan when you're early stage. You know, banks are the ones that often give loans, and they only want to give loans to businesses that actually don't need the money, right? And we as entrepreneurs are often frustrated by that definition. But on a more technical basis, as Jenny rightly identifies, there is a time for you as a business to take equity, as in to raise money in exchange for shares in your business, and there's a time to take debt, right? You know, if you're raising money to grow your business through staffing or marketing or a similar capex, it doesn't have an immediate return on that dollar, but might be a longer term investment you're making. Equity is much more sensible. But equally, you know, if you're financing working capital, you're a clothing business that's got a big order that you're able to, you need to raise money quickly in order to turn that order and get cash back from that order very quickly. Equity is a very expensive way of doing that. You're much better off taking a loan and debt, because that's something that you can turn, pay back, and then you retain your equity. So it is very important as entrepreneurs to figure out what's the right funding route for you at the right stage of your business, and act accordingly.
Absolutely. Peter, is there anything that you'd add to that? Because SANAD, obviously, as we saw from the video, through its many partnerships, lends money to businesses that perhaps, you know, aren't trying to be, as Jenny put it, you know, the next Kareem. That they're smaller, family-run, family-owned organisations. So anything that you would add to the definition that we're kind of pulling together from the previous two panelists?
Yeah, sure. No, I think Jenny and Chris summarized it quite well. And maybe to add to that, I mean, not only that fundraising, especially when it comes to equity, is quite cumbersome and lengthy for founders, it's also extremely unpleasant. And for us as investors, I mean, we have to put ourselves in their shoes as well, that these are people that want to build products, run fast, ship products to the market, iterate, see the results. And fundraising completely takes them out of their comfort zone and out of their shoes. And in most of the cases, they also don't know a lot of the tricks and a lot of the things that VCs could pull on them. And I think it's important for us as investor community also to be very supportive of the founders, very supportive of this process. And once we invest as well, going forward, to kind of like handhold them in the capital raising process, because it's not something that your typical tech founder would really be comfortable with doing and knowing all the kind of like nuances there. Yeah, and as I mentioned as well, you raise different type of capital, different type of funding in the different stages of your journey. So of course, at an early stage, you would be looking more towards raising equity, maybe first starting off raising money from an angel investor or several angel investors, or from a seed fund that could provide you with capital relatively quickly. Maybe do even several convertibles before doing your first priced round. And then going up the ladder to the Series A, Series B stage, then you're looking for more institutional money, where the fundraising gets more delayed, takes more time. But yeah, and the process becomes much more cumbersome. And then at a later stage, depending of course on your business model, you might look into raise debt as well. And this is indeed interesting to have this balance between equity and debt. But actually what we see in the market is that equity is still kind of like is the predominant way for companies to grow. And even though some companies, for example, lend money to other businesses or have more of a lending business, they still raise equity to lend, for example, which is kind of like an interesting trend that we see. What we have been used to, for example, to see companies that provide lending, like the typical financial institutions, get money either from deposits or from debt financing that they gather. Now there are a lot of like new fintech startups that actually raise equity that they on lend after that. So it's a bit, the whole mix is a bit changing right now, and I think this is all because equity is just widely accessible right now. There's just so much money out there.
So you touched on a few things there, Petar, and one thing that's clear from speaking and hearing the three of you speak, both now and in our previous conversations, is it's obviously quite a complex topic, and not everybody that runs a business or starts a business is a finance major or an MBA. So, Chris, a question for you: what are some of the big misconceptions that you see about raising capital? The things that you encounter time and time again from entrepreneurs or from small business owners that you know, having spent more time in this arena, are just incorrect, or, as I said, misconceptions?
Well, I mean, there are many. I mean, as Petar said, we as entrepreneurs, we're very good at our product or our service, but when it comes to raising money, it is, scary and new and something that we're not used to. You have to be very prepared as an entrepreneur for your baby to be called ugly day in, day out, right? When you're raising money, and it's not something we're comfortable with. And so, in that respect, there are a lot of misconceptions because entrepreneurs often, they understand it's a requirement, it's a necessary evil, but it's not something that they want to focus their time on because it's something that is outside of their, if you like, their comfort level. But I'd say, I mean, there are many misconceptions, like I say. I mean, one is that, and not everyone has this, but that it is, that it's easy and that it's quick, and you only have to do it once, right? It's not easy, it's not quick, and you're not only going to do it once, right? Once you start raising money, you're likely to be on that money train and the money hunt for the rest of your life. You have investors to answer to. You probably raise money based on a certain growth story that probably requires further funding in the future, and you need to get used to as an entrepreneur that you need to be spending every day thinking about how your company is going to make money or how it's going to raise money, right? When you're raising money itself, it's not quick. It's not just having a few conversations and then you can get your money. You may be lucky and it may be that way, but we at Eureka, when we're trying to get our entrepreneurs what we call fit for funding, is really get them to think of this as a campaign, right? It has a beginning, middle, and end, right? You need to be very, very well prepared in terms of your business, in terms of your narrative, but also in terms of the outreach you're going to have. Build out a hit list of investors, go and speak to them, try and find ways to get introduced to more and more investors, and it takes time, right? It is not quick, and I say that not really to scare you, audience, but to empower you. Okay, it's not quick, right? It's not quick for me, and I'm an expert at fundraising. It takes time, and that's okay. You can embrace that, and you can work from that. But I mean, I'd also say one important perspective technically is often entrepreneurs, when they come to us, are fixated on valuation, and the most important thing to them is the price of their company when they're raising money, right? When we are reading an article on TechCrunch or entrepreneur.com that says that company X just raised $10 million, right? That's all you hear. You don't hear about the terms that they had to give up in order to raise that money at that price point. And so I implore you as entrepreneurs to be, when you're raising money, look very carefully at a balance between the valuation and the money you're raising and the terms, as in the shareholders agreement, the rights that you're giving to those shareholders as well. Because you can, as an entrepreneur, survive what we would call, a down round or a low valuation, but you will find it very difficult if you're going through multiple funding rounds to survive a really harsh term sheet or set of rights that you're giving to those shareholders coming in, and maybe
Absolutely.
we can dive deeper into them later. But you know, it's very, very important. It's something that is very much overlooked by entrepreneurs that are fixated on that valuation.
And I can see from Jenny's face that she's got some thoughts on this as well. So Jenny, I'll pass to you. Are you seeing similar things, you know, in your own organization and with the businesses that you're partnering with and funding?
Yeah, sure thing. And I hear what Chris is saying, and I nod and I smile, because really, you know, don't underestimate how long it takes. And I think just to put you a little bit into perspective of that, a few years ago, you know, I was speaking to a lot of different entrepreneurs. I was still in VC, and you know, it takes them easily sometimes up to a year to close a funding round. And then I was speaking to actually one fintech startup out of Sweden. I'm originally from Sweden, but I'm based in Jordan for many years. 15 years I've been here. And he was saying that, you know, Jenny, it took us a really long time to, you know, to close this round that we were in. And I was like, oh, so how long did it take you? He's like, yeah, it took us like 5 weeks. So, you know, in this part of the world in particular, it takes a very long time. And it's, I think also it's important that you need to realize that, as Chris is saying, you know, this is, you know, you have to raise several times. And if you give up something like, you know, 15 to 25% of your company in every round that you're raising, you know, when you make it big, which we hope that you will do, the chances are that you've given up the majority of your company to someone else, right? So yeah, I mean, there's plenty of misconceptions, but I think really, number one, underestimating how long it's going to take you, the complexity of it, but also how expensive it can be when the company make it big.
For sure. Petter, I'm going to pose another question to you. SANAD obviously is focused on Middle East, North Africa and Sub-Saharan Africa. So talk to us about some of the trends that you as an organization and you as an individual are seeing in that region when it comes to raising capital in the last 2 to 3 years.
Yeah, I mean, I think one of the biggest trends that we see, and I think it will become apparent this year in particular, is that there is a record amount of funding in the region. And we're not even over with 2021, but I think we're almost surpassed the total amount invested from last year. And I think it will be much higher by the end of the year. So yeah, what we see is funding rounds are getting larger. Valuations are getting much higher than before. Also, the number of deals has increased. Very early stage companies are finding a large pool of investors that are willing to commit quite some significant amount of funding, which wasn't the case before, definitely. And yeah, that's a general global trend that we see, and I think it's prevalent in the MENA and SSA, and it's really the result of abundant capital lying out there trying to find the targets, and this is the result of it, having increasingly high funding rounds.
What are the outcomes of that, Petter? You know, more capital out there looking for a home. That sounds like great news to me if I'm an entrepreneur looking to raise money. But does that reflect, or does that necessitate VCs or investors of any stripe taking bigger risks, you know, lower levels of due diligence, writing bigger checks earlier? What do you see as the kind of outcomes of that surplus, if you like, of capital?
Yeah, no, definitely. Everything that you said, actually. I mean, it's really, if you have too much money chasing too few deals, this is inevitably what is going to happen. I mean, there's either going to be a lot of risk being taken of financing companies that should not have got like 10 million if they could have done it probably with 5 million for a seed round, because we see in quite high seed rounds now and even higher Series A rounds. And also, yeah, just the level of due diligence, probably it's much to a lesser degree in a sense, because there are many funds out there trying to be part of deals that it's your main kind of like competitive advantage becomes the time that you take to actually finalize the deal. So we see that, I mean, there are funds out there that, for example, could write you a check quite quickly. There are others that could take more time. Of course, you as a founder, if you have to choose, of course, you would go for the VC fund that could do it much quicker than
Absolutely.
the others. So there's a bit of a competition in that. But I mean, something to keep in mind that the bigger question is how long could this continue, right? I mean, this has been going on for quite some time, and now, of course, the macro situation starts to change. Inflation is picking up. There are quite a lot of conversation whether this is temporary or more long-lasting. But inevitably, interest rates are going to increase globally. Flow of capital might change direction. So, yeah, it's yet to be seen how the global kind of like investing environment would change. For now, if you're a founder, it's the best time to raise capital, I think.
Well, good news. I suspect any founders on the webinar will agree. I'm just going to launch now a poll. So keen to hear from our attendees their insights on the questions that we're posing here around raising capital, get to know you a little bit better. We'll leave that up and running for the next 5 minutes and continue to speak to our panelists here. I'm also noticing some wonderful questions coming in for the Q&A. Please do keep submitting those. We're keen to put your questions to the panelists in around about 15 minutes time. Jenny, I'm going to come to you with a question now, which comes off the back a little bit of what Petter was saying there. He said, okay, if you're an entrepreneur, if you're a business owner and you're looking to raise money, and there's somebody who'll give you money really quickly and somebody else that's going to take more time, everything else being equal, of course, you'll take the money quickly. But what are the things that might not be equal? What are the things other than money and speed that as a small business you need to be looking at and thinking about when you're raising capital?
Sorry, can you repeat the question again, Ian? My internet wasn't very clear.
No problem at all. I said, Petter said earlier that everything else being equal, as a business owner, you would seek an investor that invests quickly rather than one that invests slowly. And I think we can all agree that makes sense. But of course, we never find two exactly equal investors. So what are the other things other than the amount of money and the speed at which you can raise with that particular investor that you should be considering? What can they give you other than cold hard cash that adds real value to your organization?
Sure. Okay, great. Now the internet was clear. So yeah, I think at the early stages when we set out to design our fund, Amam Ventures, we met with a lot of entrepreneurs. And by the way, so Amam is the Arabic word for in front or forward or, in the future. And I really think, I mentioned in the beginning, we are a genderless fund. So we want to put more women towards the front, whether it's they are entrepreneurs, whether there's in senior management, or even they're coming into going back to work after they had, a child. And when we met with a lot of the female entrepreneurs, it's very clear that they need a lot more than just money. And it goes also for, male founded startups as well, but women in particular. So when we designed it, we say, Amam Ventures, we're going to give funding. We start from $250,000 up to $1 million. But then also alongside of that funding component, we have this non-financial component, right? So there we have a platform called Alkan. And again, Alkan is Arabic for pillars. And that's really, what are some of the basic building blocks that you need in order for you to be able to, first of all, come to us and be able to raise money, but also what do you need after you've received money? So we do a lot of investment readiness programs. We have a very cool program, which is pre-investment, that we have a business innovation bootcamp. We do a financial projection course called Master Your Numbers. So kind of just help them get up to speed to become investor ready. Because if you look at SMEs as opposed to startups, most of them have not been polished. They haven't been through an accelerator. They don't know that, the startup lingo, and they're just not ready. So they need a little bit more hand-holding and preparation work upfront. But then also after, when you receive the funding and you get, you have, let's say $1 million, there's plenty of other stuff that we need to help you with. So, entrepreneurship can be a very, very lonely journey. One of the things that we identified that a lot of companies and entrepreneurs need is, for instance, a CEO coach. It's not a life coach per se, but it's someone that really helps them on that journey of being a leader.
Yeah.
What we do before we make our investments is that we do customized roadmaps. And that's really where we identify, is it is it branding that you need help with? Is it, a franchising that you need? Is it, it could be plenty of, corporate governance. We often tend to do also gender lens action plans to just really help them on that transformational journey of how they can become more inclusive. So for us, the non-funding component is super, super important. And I think, it's, going back to looking at some of the trends, I started back in VC here in 2014. And at that time, it was very much the investors that had the, all the power. But now I'm really excited to see that. I feel that, the tables have turned a little bit, and there's actually competitions from the investor side to be able to fund the best startups. And I think also, a lot of the big players are starting to eye the region. I mean, Sequoia coming into making an investment in Egypt, I mean, that's a big deal, right? Yes. So I think there's so many different trends that are happening in the region. And I think it's a very exciting time to be in entrepreneurship and investing into this region at this time.
Absolutely. And you talked there about not every business that's looking to raise capital has been through a accelerator program. I think there is this vision of somebody who's raising capital, or an entrepreneur is this, this single person that has this vision that goes beyond what everyone else can see. They see the future, Elon Musk type character, or Steve Jobs, may he rest in peace. And they've got this fascinating idea, and all they need is to persuade 2 or 3 people with money that they're right, and then they can, change the world. But of course, we know that's not the story of most businesses that are raising capital. You talked there about the big deal of international funds coming in and putting big money into the MENA region in particular. Do you think that's reflective of an increased awareness of the region? And is there also a component that is to do with the makeup of some of those funds now starting to look a little bit more like the region? Because there has historically, and I suspect, frankly, it's still a bit of an issue, been a problem with VCs in particular being, very Western, white and male. Do you think that there's a step change happening there? And if so, how does that impact the region?
Is the question still for me, Ian?
Yes, sorry. Yes, it is, Jenny, indeed.
Okay, yeah. So yeah, I think definitely, I always, as my late previous colleague Emil always used to say, the Middle East is like the final frontier on so many different fronts. We're talking about, financial inclusion. We're the most financially excluded region on the, in the world. If you're talking about what I do now, which is, trying to get more women and entrepreneurs and to get them to start companies and help them grow their businesses. This is, we're the most least, empowered region on the planet for women, right? So there's so many different, yes, we probably might be a bit of a rough diamond, but there's plenty of opportunities for them to look at here. And I think as valuations globally goes, haywire, I think, this is also still a region that has a country, for instance, like Egypt. I mean, there's 102 million people there. There's plenty of untapped potential across. I hope that answered your question.
It does, absolutely. And Chris, just coming across to you, obviously one of the things with Eureka is it's not just huge VCs that are investing money. It's individuals, it's smaller institutional cash. Talk to us about how the makeup of Eureka, does that impact the businesses that you see the organization or the investors looking to invest in, or the way that you onboard companies that are looking for investment?
You mean in terms of our deal flow or
yes,
our business model? I mean, we're a global platform, so we operate across 3 continents: Europe, and the MENA region. I'm speaking to you here from Dubai. This is our home, if you like, and so a lot of the business we do is GCC based, but we very much are a global platform. But we are also sector agnostic, right? So we don't focus on a certain vertical, fintech or e-commerce or whatever it might well be. We pretty much are open to all. The key difference between a platform like us is that we are empowering entrepreneurs to reach out to their network and our network, with about 35,000 investors on our platform, who are mainly angel investors, right? They're not VCs. You know, as often in these panels, we are focused on venture capital, right? The reality is, unfortunately for us as entrepreneurs, the vast majority of us will fly beneath the radar of venture capital, right? You know, we are not suited for a VC model. VCs have a very, very tight mandate. As Petter saying, money is cheap right now. VCs are actually, they're raising much more cash for their funds. But that doesn't mean they're investing in more deals. It means that they're just investing in bigger deals, right? Because they would just move further up the food chain because they've de-risked the product. There is a vast amount of money out there that is not being invested by professional investors like VCs or private or family offices and so on and so forth, but are people that are are investing their own money. They're investing often emotionally because they believe in your story and your opportunity. Here in the Middle East, you know, when we are raising money for a business, there will be a mix of professional investment, as in venture capital, and also non-professional, as an angel investment capital in a deal. The quality has improved dramatically over the last 3 to 5 years. The scope and the depth of the entrepreneurial ecosystem here in the MENA region is vastly different than it was 5 or 8 years ago when we started in this space. And as such, as both Jenny and Petter are saying, that is why there is international interest in the MENA region, because it's basically been de-risked, right? It's been around long enough, right? We do have exits like Kareem. More stuff is happening in the MENA region, but also the cup spilleth over, right? There's too much money chasing big deals in Silicon Valley and otherwise, so they've got to look further afield and somewhat adjust their if you like, their assessment in terms of risk and get involved in more deal flow elsewhere. But there's loads of stuff going on here that is brilliant, and entrepreneurs can raise their money locally and do it, in our opinion, relatively easily.
Excellent. And you mentioned there something that you and I discussed a little bit in our previous call, Chris, which is, I think people perhaps think of investing money as a purely rational process. Okay, well, I see that this business is going to grow, 20% year on year for the next 5 years. I can get X% of it for Y amount of money. That seems like a good idea to me. My investment will be worth more than I'm putting in. But you rightly say it's not that simple, because the people making the decisions, even at VCs, even at big institutional investors, are human beings. So how does that impact what you need to do as an organization looking to raise capital? Does it need to become an emotional pitch as much as a rational pitch?
Yes, but it depends on your investor audience, right? So, whether you're raising money from venture capitalists or angel investors, there are narrative people and there are numbers people, right? So there are people that are going to be investing because of the story they're hearing and the opportunity that they believe that they're getting. And there's others that will be very much analytical and looking, as you say, Ian, at merely the month-on-month or the quarter-on-quarter growth story that's such that fits their, whatever their analysis is in terms of how they're looking to invest. My advice to you as entrepreneurs is spend as much time as you can do with narrative people rather than numbers people, because we as entrepreneurs often lose that conversation when it's purely focused on an Excel spreadsheet, because anyone can challenge your business assumptions. Find investors or get used to telling a story. People are investing in a story. They're investing in you as an entrepreneur through, you'll hear this often, they're investing in the jockey, not the horse. They want to see your passion and your persistence and all that fun stuff. But at the end of the day, investors are mainly, they're interested in your story, right? And the better you can align your story with your business model or the opportunity for an investor, the more chance you have of raising money, right? Focus on team, focus on traction. People need validation. Investors don't want to feel like they're the only idiot in the room, right? They want to invest when either the business has been de-risked, there's validation through the business that you already created, right? The amount of customers you've got, or maybe other investors that you brought in, right? Yeah. But they're mainly interested in the story. But equally, right, understand, as you said, investors are people. to get is what the best businesses aren't the ones that always raise the cash, right? It's the ones that play the game of this, right? And create, or if you like, push the right emotional buttons with investors, create a competitive environment for investment, you know, create FOMO, fear of missing out in terms of that. You know, you've really got to push on the greed buttons with regards to investors. It's a sales process like any other. You're not going to raise money just through an Excel spreadsheet. It's about having the right story, you know, building the right validation and traction, but then really creating this fear of missing out through deadlines or competitive environments or otherwise that actually gets them over the line. It's very often easy to get an investor to say, I'm interested in investing, but to get them to actually put their hand in their pocket or sign that check is often an entirely different case. And that is often the bit that entrepreneurs come unstuck, right? You've got to create that environment for them to want to act quickly rather than drag their feet.
Absolutely. Petter, what are some of the things then that companies are looking for investment can do to help investors to see the value of their organization? What are the things that they should be prepared with that give them the best chance of being successful, whether that's in raising, versus equity or versus debt?
Yeah. I mean, here there are a couple of things that founders, companies can do in general to kind of like maximize their chances to land a good deal and to secure the necessary funding on the first place, but also to secure it on good terms and from good investors with a lot of value added. Several things here. I think founders usually are a bit complacent on doing due diligence on their investors. This is something that I find out, and I'm still being quite surprised by it, because investors want to invest in your company. They do a horrendous DD on you that is very long and poke every single hole and look in every single spreadsheet that there is. But the founders themselves rather don't do much DD on the investors. And I always encourage people to go and speak with some of the other partners at the VC fund. Do some reference calls with some of their existing portfolio companies, ask on the market what they think about them. And just get a better sense of, are these the actual partners and people that I want to commit to? Because let's face it, I mean, getting investors on board, it's like a marriage, right? I mean, it's a very long-term engagement, and it's not just about surviving the several months fundraising process and then bye-bye, I never speak to you again. It's quite a significant commitment. So founders need to do DD on their investors. I think another point where they can maximize value is really on working with several investors at the same time, running a semi-competitive process. And this increases your chances quite a lot. We see this from founders. They're so eager to get the funding round done that the moment they receive the first term sheet from a VC, they're already running with them. And then this term sheet, the first iteration of it is going to look one way. By the time you sign it, it's going to look totally different. So it's very important to run in parallel with multiple other VC funds or other angel investors or whoever you are raising from, but just to have some competing bids on the table. And really take your time, don't rush the process. And this will definitely maximize your chances of landing on a good deal in the end of the day.
I can see Chris is keen to jump in there, so I'll let him come in. Your thoughts on that, Chris?
Yeah, I mean, I agree with everything Petter's saying, and obviously you need to, as a business, ensure that you are fit for funding, that you have the right documentation in place, that and you've created the right forum, if you like, for a due diligence process to happen. But if you need to focus, in my opinion, as an entrepreneur, when preparing your business for raising money, the most important factor is momentum. Right? Whether you're manufacturing that momentum or it exists, you have to create momentum. People are investing in you, not based on where you're at today, but ultimately what they're going to get out of you in 1, 3, 5, 10 years time. Okay. And they're investing, they want to invest on that curve. They want to effectively feel like they're getting you for cheap, right? They're coming in now, but in a year's time, you're going to be in a totally different position. So you have to create momentum, whether that is customer momentum, new market momentum, investor momentum. You having more and more investors that signed up, and therefore, again, you validated or de-risked the investment opportunity. But figure out your momentum as a business and build that into every element of your story when raising money, because that's what's going to get people to act.
Excellent.
Yeah, that's
Right, so
very true indeed. I think like figuring out your timing of your round is quite important. Like take your time, of course, have in mind your runway, but really think very carefully the timing of your round and what kind of figures you are showing at the time you're reaching out to investors. If this means waiting for another month or two, this would significantly help your story. So that's quite important.
Excellent. So we're going to move on to some questions here from the audience. Thank you for sending those in, folks. If you've got any, please continue to send them in. We'll try and get through as many as we possibly can. And to that end, I'm going to ask the panelists to be as concise and punchy as they possibly can be with answers here. But first of all, a quick question for you, Jenny, that actually comes from the poll results. So we asked people, what's the most difficult thing about raising capital? And we gave them a series of options, as you'd imagine. And the one that came out top by a country mile, it was at least 3 times higher than any other option that was selected, was access to investors. So how does somebody who is, who is not an MBA tech entrepreneur, but is a family organization or a small, medium-sized enterprise in the region that we're discussing here, so MENA and Sub-Saharan Africa, how do they get access to investors? What are the important things there?
What was the last part of the question? Sorry, the line is not clear from my side.
No problem. How do organizations and individuals get access to investors in this region?
Yeah, and I think that's that's the $1 million questions, right? Because if you can't get access to them, then it's how are you going to be able to tell them your story, like what Chris is saying, right? And I think that's why it's important that you have different types of funding channels. And I think what Chris is doing with Eureka is so cool because 35,000 investors on that platform. I mean, come on, that's a lot of that's a very big reach. VC, I think it's a a lot of people, they talk about financial advisors. You should go and have a financial advisor. VCs tend to frown upon those because the nature of being an entrepreneur is that you need to hustle, you need to find your way, you need to get your elbows and whatever. And if you need a financial advisor to get you in front of a VC, then you probably don't have the the right DNA. You can obviously that could be a right or wrong, but I think that's often what VCs tend to do. I think you have to have your ears to the ground. You have to find who are the ones that resonates with you. I think it was it Peter who said that you need to figure out and do some due diligence on your investors. I mean, I think there's nothing worse than when you sit in the VC or in the investor space and someone comes to you and they start talking about something that you have tooted the horn 100 times, that we talk about gender, and then the ones that approach to be has nothing to do with gender. It's very simple. Go to our website and we follow the 2X criteria. It either has to be a female founder, or they have to have a certain percentage of women in senior management, or half of the workforce that are women, or a product or service that caters to women, right? So really do your due diligence and find the ones that fits your DNA. Are they impact investors? Are they commercial investors? We are impact driven. Impact to us matters, and that is as important as financial returns. So when you come to telling your story, yes, of course, you need to be able to show the growth and the momentum, but also there needs to be another impact component as well to say, that we can, if it's a double bottom line or whatever it is that you're looking to do.
Sure. So I'm going to ask you all a very quick fire question here. Have you made an investment recently, and what drew you to that company if you have? I'll start with you, Chris.
Yeah, I mean, I've made a number of investments recently. I mean, what drew me to those companies? The entrepreneur approached me directly. I had a direct relationship with them before that they asked me for money, right? Because ultimately, the moment that somebody comes and asks you for cash, the psychological barriers go up and it all becomes very you're suspicious and you think differently, right? Entrepreneurs have come to me and asked me to mentor them or be on their advisory board, and have had cleverly a very soft way of getting me to be interested and listening to their story long before they then come and say, by the way, we're doing a round. And so, I mean, it is entrepreneur driven, but again, to Jenny's point, you need to always be fundraising, guys, right? This is not just something you turn on 3 months before you need the cash, okay? You're always fundraising. Build up a network of individuals, tell your story, do it in a way that is in a safe environment, that isn't necessarily funding driven, so that when you come to them later and ask them for money, they're already, they're already hooked in terms of your company.
They know who you are. Peter, have you made any investments recently? And if so, who and why?
Yeah, we recently made an investment in Kenya. Actually, as part of our fund, we have the mandate now to invest in sub-Saharan Africa, which is quite an interesting region for us with quite some opportunities. And how we came to invest in this company is through a local fund that introduced us to the company. That was kind of like always a good sign when you have trusted funds, reliable partners to kind of like introduce you to a company and participate in their funding rounds. So that always helps.
Yeah. And Jenny, any recent investments? I suspect there must be one or two.
Yes, indeed. So yes, we have made an investment. It's in an entrepreneur that actually I met 2 years ago, and I think it's important to also mention, you have to, we're not going to meet you now and then next month it's a it's a yes or a no. Yeah. We met them on specific occasions, and different dots, and you have those dots that kind of connects the line, right? This particular entrepreneur has an incredible story. She's working towards it's in education and vocational training in specific, and really what she's trying to do is to try to address the rampant unemployment in this country in particular, right? And I think it's a ticking time bomb. So when we're talking about impact, that is something that for us it's super important. Job creation.
Yeah, excellent. So we'll go to another question from our panelists. You may be able to see it on the screen, but it's specifically for you, Chris. And Chris, the question is, do you see a Preseed Fintech startup from the MENA region that you think is fit for a really good first round of financing, and should they use Eureka?
I mean, get in touch, right? We are, as a business, we obviously, we have a selection criteria. We list probably about 1% of the entrepreneurs that apply to us, so it's relatively stringent. But we're also entrepreneurs ourselves, and we like to give back. So please get in touch, and if we can't help you, we'll do what we can do to push you in the right direction. I could say we're sector agnostic. We mainly focus on post-operational, post-revenue businesses, but that sweet spot is quite elastic. But yeah, get in touch, and we'd love to speak to you. And like I say, if we can't help you directly, we like to put a lot of good energy back out into the ecosystem. So we'll do what we can do to point you in the right direction.
Lovely. And I should say there'll be an email going around after the webinar to all of our attendees that will A, have a survey, and please do take the time to fill that out, but B, will provide an email address where you can send questions. So if you submitted that question, you need access to Chris, please do send us an email and we'll put you guys in touch. Another question here, one specifically for Peter. Peter, what type of funding is SANAD providing for early stage startups? And I think you covered this off right at the start, but if you could give us the 30-second to 1 minute version of that would be fantastic. Yeah, sure.
We to early stage companies, we provide equity financing. We do ticket sizes between $1 million up to $7-8 million. So with on the lower segment, we can target early stage companies at seed, Series A, Series B stage. Our sweet spot is at the Series A stage when we used to come in. We usually lead rounds, but also happy to follow if there are other investors as well. And also another thing that we provide to early stage companies, apart from the commercial equity funding, is the technical assistance support, which is really quite useful for them, so that we can structure various projects, bring in consultants, really on a needs basis, so that we can build up some capacity at those companies at an early stage. And the great thing about this technical assistance facility is that it is non-commercial and it's separate from the equity funding.
Excellent. So the question is, if you're not a unicorn and you're not going to become a unicorn, then what do you need to do differently? I'm going to pass this to Jenny, because Jenny, I know you and I had a conversation about zebras, and perhaps you could explain to the audience what you mean by that.
Sure thing, Ian. So again, I'm going back to the design thinking that we did when we created our fund, because by the way, we are an investment fund, but we're also a startup, very much like, I'm sure many people on the calls are. So when we said, we set out on this journey to create this fund, we also felt that, there's plenty of VCs out there. A lot of the companies that we meet with, they don't, like I said before, they don't want to be the next Uber or the next Kareem. So I started doing some Googling and I came across this Zebras Unite concept, and they were talking about, everyone knows what a unicorn are, and they're incredibly rare. They're like magical, right? There's so few of them out there. And then when I recently had the chance to go to, actually before Corona, to go to on a safari in Tanzania, and when you look there out in the savannah, there's zebras, there's like everywhere, right? There's so many of them, and they're just kind of like SMEs, right? If you look at the economy, 96% of the economy are made up of SMEs. So I think zebras is more about, instead of trying to become that, trying to be in the cool kids club, I guess, which are, less than the 1%, then, it's not too bad to also be someone that, they have a balance, profit with purpose, they focus on social impact. So that's kind of where the Zebras movement is coming from, right? It's a shared prosperity type of model as opposed to, a winner takes it all type of thing. And this is not at all to bash, the VCs or to bash the unicorns at all. We need those are great, but I also think that there needs to be more alternative types of funding out there, and it needs to be alternative type of cultures as well for entrepreneurs that they feel that they can belong to and that that really resonates with them. So that's kind of briefly about zebras versus unicorns.
Thank you, that's very kind of you. I'm afraid we're out of time, folks. Apologies if we didn't manage to come to your question in the Q&A. We'll try to get some answers from our panelists and post the answers of the questions we couldn't get to on Twitter or LinkedIn. So keep an eye on the SANAD Twitter feed, that's SANAD_MSME. Thanks very much to our three panelists, to Chris Thomas, to Jenny Alzain, and to Peter Chavdarov. Thank you from me. My name's Ian Jenkins from Base 115. I've been your moderator. Please do remember to provide feedback on the email you receive following the webinar. And do join us in November. We'll be discussing insurance, lending, payments, and cash management for micro SMEs and how fintech and technology are changing up those areas. There'll be more information again on the SANAD's Twitter and LinkedIn profiles, so keep an eye open there for a sneak peek at who the panelists will be and for the date and time. Thank you very much, and we look forward to seeing you all then.